We're live, just waiting for a few attendees to come on board. Just give it a moment.
So Helena, the idea is I'll be going for about 20 minutes, then it's your turn.
Yes.
That's our timing? Yep.
All right. Maybe I'll kick off with the introduction. It's quite brief. Good morning, all. Welcome to today's webinar. My name is Stephen Connors, CEO of the FSAA. Just as a way of introduction, I just want to thank everyone for their recent participation in our endeavours in the online space. And the participation has been exceptional, and today is no different. We have over 100 registrations for today's event. Over to today, we are definitely in uncertain times given COVID-19, and no one can really predict how the future economic conditions will unfold. And putting the economics aside, you're looking at traditional indicators such as growth and unemployment. There's also a lot of uncertainty around what government will do, job keeper, job seeker, etc. And then you've got what the virus will do. It's absolutely difficult times in terms of accounting and judgment. So today the FSAA is proud to introduce a couple of distinguished guests from the AASB to really talk about the implications of this uncertainty on our financial reporting. And we have the pleasure of introducing Dr. Keith Kendall, recently joined chair of the AASB last month, replacing Chris Peach. Was also a great supporter of the FSAA. Dr. Kendall was a partner of Rigby Cook Lawyers and a barrister and a lecturer at La Trobe University. So welcome, Dr. Kendall, and congratulations on your recent appointment. And today also we are lucky to have Helena Simkova, the Acting Technical Director at the AASB. And Helena brings years of experience in this technical accounting and audit space, working in private and public sectors in Australia and in the Czech Republic. So the FSAA and our members really appreciate you making the time today to talk to us on this topic, and it's I guess testament to the demand and the need to hear about this, the volume of people interested today. So what I'll do, I'll hand over shortly to you, and then come back on when we open up for Q&A at the end. For members, what I would suggest, if you have any questions throughout the presentation, given the number of people online, just pop it into the Q&A and we'll try and get to that at the end of the presentation and get to as many of your questions as possible. So without further ado, thank you, Dr. Kendall and Helena, and over to you.
Well, thanks very much for that introduction, Stephen. And it really is a pleasure to be here. Now, what Helena and I intend talking to you today about some of the activities that we've been looking at that have come to the fore because of the COVID-19 situation and how this affects financial accounting reporting matters. Now, as you see on the slide there, we've got a number of aspects that we want to go over with you in today's session. I'll be speaking initially about what we've been doing around the going concern assumption and the reporting on that. Related to that are events that occur after the reporting period and how that's implemented within the reports. Helena's then going to take over and talk about impairment and fair value measurement, and also expected credit losses under IFRS 9, as well as other developments and resources before hopefully we have a few minutes or more than a few minutes for questions at the end. So moving on to going concern, we'll move the slide on. Thanks, Helena. late last month, so it's still warm off the press, the AASB, in conjunction with the Auditing Standards Board, released a joint publication. It's titled The Impact of COVID-19, Ongoing Concern and Related Assessments. This is quite a comprehensive document that goes through a number of aspects affecting the going concern assumption, and in particular matters that might arise specifically as a result of COVID-19. Now, one thing that we need to emphasise with respect to this publication, which is available off the AASB website, the AASB has an entire page on the on its website with filled with COVID-19 related resources. So I'd recommend you having a look at that. This is our most recent publication that's come out, and we've got a couple of other publications in the pipeworks as well. It's very important, though, to realise that this publication doesn't amend, interpret, or provide any sort of advice on the application of Australian accounting standards, auditing standards, or the International Financial Reporting or Auditing Standards either. It's a guide only. This is something that we've had to be quite mindful of. It's not adding to any formal requirements under the accounting standard. So it's purely a guide in terms of how to apply the going concern assumption, but it's something that we perceived a need, determined that there was a need in the market for this sort of guidance, and it has been received very well since it has been released. Now, sorry, if we can go back just one moment, back to the previous slide. Thanks. So there are a number of aspects that it goes through. So directors' duties, going concern assessments. Once those assessments have been made, what sort of disclosures need to be made around going concern. It also talks about the auditor's responsibilities, and if you go through that document, you'll see that those considerations tend to be somewhat closely aligned as well. It's one thing to report the matter, but then there needs to be taken into account what the auditor will be looking for as well. All right. So when preparing the financial statements, management's required to make an assessment of the entity's ability to continue as a going concern. This means for its operations it loosely means be able to continue its operations indefinitely. There's no end date in sight here. Should point out, for those of you that are familiar with the legal requirements under the Corporations Act, this is a similar but very distinct requirement from solvency. The two are often confused, and whilst they are very similar concepts, they are very distinct. So just thought for those of you that aren't necessarily familiar with the going concern requirement, to make that distinction there. Now, whilst the standard doesn't specify what has to happen under particular circumstances, in essence, you'll find yourself in one of four scenarios. Now, this is presented in the flow chart here, the way things tend to go. Sorry, if we can just have the flow chart for a moment. Yep, thanks. So you can see through the flow chart there that this covers off on broad principles about what to look for, how to assess the going concern for that period, and then identifies the outcomes, the practical outcomes for the financial report here. Now, before we move on, just to note that the reason why going concern is so important is this forms the entire basis on which the financial reports are prepared. If a business is in an unfortunate position where the going concern assumption is not viable, then the reports need to be prepared on a different basis, because what that means is that there is an end date for the operations in sight. And so consequently, this means that management has no realistic alternative but either to liquidate the entity or to cease trading. Now, the standard doesn't specify the basis on which the accounts need to be prepared under those circumstances, but the basis on which they are prepared, which is a matter for management judgment, needs to be disclosed. All right, so if we can move on there. Okay, sorry. Okay, so in terms of trying to look for what actually needs to be put into the report, the starting point is that management needs to consider what's going to happen over the next 12 months. Now, it's important to understand that the standard is explicit, that it's not limited to the next 12 months. That's where the focus is. But if management is aware of matters that won't arise for more than 12 months into the future, but they are aware of it nevertheless, that needs to be taken into account in respect of making the going concern assessment. So initially, where in making the assessment, step one is to identify whether there are any sort of indicators that the going concern assumption may be somewhat uncertain. Now, in the COVID-19 situation, some examples of this, and this is what's gone through in the publication, some examples might be a temporary shutdown or restrictions on trading, reduced demand or the shutdown of certain revenue streams, the unavailability of certain resources that might be needed to continue operating. This includes access to finance, for example, but also supply chain considerations due to suppliers maybe being shut down. Financial difficulties of debtors, for instance. So businesses owed money by entities who themselves are going through these sorts of problems, and because of the COVID-19 related problems, may not be in a position to pay. Also, whilst the entity itself may not necessarily be showing explicit signs of about to being shut down, if there are comparable businesses operating in the same entity, in the same industry that are shutting down, that might indicate that there are possibly problems for the entity in question on the horizon. Now, after looking for all these sorts of indicators, if there are no indicators there, or nothing specific arises, then there are no issues. The going concern assumption is valid. The standard doesn't require any disclosure specifically to be made in those circumstances unless the disclosure would be material to users. Now, if there are some indicators that are identified as possibly undermining the going concern assumption, then step two is to go and assess certain mitigating factors. So, all right, we've identified that there are certain problems here that the entity may encounter. What other circumstances are there that may mitigate these factors, and with the result that, notwithstanding that these indicators are present, the going concern assumption is still valid. In a COVID-19 situation, some examples that we go through of mitigating factors here might be the availability of certain government assistance. Also the access to liquid assets that may be able to be sold to meet the debts. There might be access to alternative financing that's available. There might be additional ability to reduce overhead or administration costs, at least on a temporary basis, to see the entity through the immediate period. There may also, because this is such a wide-ranging situation and it affects so many entities across the whole economy, there might be an improved ability to defer liability settlement here. So debts that may have been, or debts that may be due over the next 12 months, there may be an increased ability to be able to negotiate a deferred settlement period with those, because everyone's in the same boat. So it's not a particular shock when those negotiations need to happen. All those sorts of things may be mitigate to allow the going concern assumption to stand. Okay. Now, after having considered all the relevant information, management needs to conclude, first of all, whether there is a material uncertainty over the entity's ability to continue as a going concern, or if there are no material uncertainties, but in reaching that conclusion, significant management judgment was required. In both of these cases, the entity needs to disclose the relevant information about the judgment or the material uncertainties. Now, one of the things that may be expected in a COVID-19 environment is that in many cases, significant judgment may be required. So one of the things that we wouldn't be overly surprised seeing in upcoming reporting periods is disclosure of more significant judgment that's been exercised by management in reaching the conclusion that the going concern assumption is still valid. Okay. Move on the slide. Okay, so where management has concluded that, well, the going concern assumption may not be valid in particular circumstance, so otherwise the entity is not a going concern, the directors need to consider the impact on the financial reporting here. So under the first scenario, where an entity is not a going concern, just as a broad principle, that fact needs to be disclosed. As I mentioned earlier, the accounts need to be prepared on a different basis. This is not, an alternative basis is not prescribed by the accounting standards. In those circumstances, because the accounting standards don't set out how things should be done in those circumstances, our recommendation is to discuss what the entity's auditor, discuss with the auditor what they think the most appropriate basis of preparing the accounts would be, and seek legal advice. Because compliance with accounting standards for reporting entities is a legal requirement, legal advice might be necessary, and is usually a good way of about things anyway. Now, in a situation where the entity is in hibernation rather than necessarily not a going concern completely, an assessment needs to be made on the going concern assumption, which is dependent on the facts and circumstances of the individual case. And management needs to assess all the available information to determine whether, once the entity, or more to the point, that the entity will be able to emerge from hibernation and be a going concern once things return to normality. All right, moving on. So looking at events after the reporting period. So this is a scenario, this recognises, for those of you not familiar with this, this recognises the fact that, Well, for most entities, the reporting period will finish on 30 of June, the relevant year, but it'll be at least some months before the financial report is able to be released. Now, in between that, what we're talking about here are events that occur during that interim period. So between the end of the reporting period and when the financial reports are actually released. So we've got the flow chart there. This is dealt with under AASB 110. And so the broad principles, events, favourable, unfavourable, that occur between the end of the reporting period and the date when the financial statements are authorised for issue, need to be taken into account. So first question, well, it's all set out in the flow chart there on a broad basis. The major question is whether the subsequent event is what we call an adjusting event. Now, this is something that requires a bit of thought to be put into, and it can be, this is defined in paragraph 3A. No, sorry, Helena, you called that right. Thanks. So events that provide evidence, adjusting events are events that provide evidence of conditions that existed at the end of the reporting period. So in other words, an adjusting event is something that does need to be taken into account in the financial reports, even though it's based on an event that occurred after the end of the reporting period. So if the event qualifies as an adjusting event, this needs to go through in the numbers in the accounts. So an example of something where that might occur is we'll call it 30 June, being the usual point at which reporting period finishes. If it was suspected as at 30 June that a debtor may have been having financial difficulties, and that debtor becomes insolvent in, say, August, then that confirms, that insolvency in August confirms what was known as at 30 June, and so can be taken into account, or needs to be taken into account in the numbers that needs to be reflected in the numbers in the financial report that's prepared. Now, if the event doesn't so much qualify as an adjusting event, those events still need to be disclosed. So where the event is regarded as material, so the nature of the event, and then an estimate of its financial effect needs to be disclosed. And in circumstances where an estimate can't be made, then an explanation of why an estimate can't be made needs to be put in. Okay, moving on from there. All right, so how does this affect the going concern assessment? Well, where the event occurs after the reporting date results in the entity being unable to continue as a going concern, the assessment of an adjusting or non-adjusting event winds up, the distinction becomes irrelevant when assessing the going concern there. And so as a result, the reports shouldn't be prepared on a going concern basis. We're back to the considerations that I was going through a few moments ago. However, the disclosures under AASB 101 relating to going concern still need to be made. And just as a final reminder, this explicitly relates to the subsequent 12 months after the end of the reporting period, but is not limited to those 12 months. Okay. So that's all I wanted to say on going concern and subsequent events. So with that, I'll hand over to Helena now to go through, starting off with impairment.
Thank you, Keith. So I would briefly talk about the impairment of non-financial assets and the fair value measurement, which actually links to the impairment of non-financial asset. So it is evident that COVID-19 has a broad impact on domestic and global economies as well. And it's clear that it has adversely affected many businesses. However, the mere existence of COVID-19 itself does not necessarily indicate that asset may be impaired. It may not. So therefore, you need to consider whether actually COVID-19 has or will have an adverse effect on the business activities and through them on the non-financial assets. So on the other slide, on the next slide, I have few impairment indicators that can be considered. These are not, of course, it is not an exhaustive list. It's just very few examples because COVID-19 is basically expected to give rise to indicators that point to non-financial assets being impaired. So this is irrespective whether the entity measures its non-financial asset using the cost or the revaluation models. So if the current economic environment has significant adverse impact on the on the business operations to which the asset is dedicated, it may be an indicator of impairment. So I only have 3 examples on of the impairment indicators, but of course, like you would have to, when doing the impairment assessment, you would have to consider many more. But for example, you would have to consider whether the asset became idle due to suspended operations. So as a practical example, that would be, for example, airplane which is not being used due to suspended travel for the airline. Then another one is increased business costs, and that may be for various reasons, for example, due to interruptions of supply chains, or because of facilitating employees working from home, or simply because you need, you know, more cleaning services more often to actually keep up to the required standard. So another example that I have is restrictions of entities' operations if the asset generate cash flows primarily from such operations. So the example of that would be, for example, government restrictions or limitations on in-house dining for a restaurant, or number of people attending the gym for a fitness owner. So other examples of impairment indicators may be, for example, market capitalization falling below net asset value, or reduction in demand, or customers experiencing financial difficulties. The next slide is trying to address timing of the impairment testing, because we have heard lots of questions on timing. So for example, people were asking, can I wait with the impairment testing until the year end? So in general, for most of the asset, you can, because you can wait until the reporting date, because the standard actually requires you to assess whether there is indication of impairment at the end of each reporting period. But bear in mind that the end of reporting period includes also the end of the interim reporting period. However, this is not applicable to goodwill, intangible asset with indefinite useful life, or intangible asset not yet available for use. These assets need to be tested for impairment annually, at least annually, at the same time, and of course, whenever there is impairment indication. So, for example, if you performed annual test for goodwill in the first half of the year, but there are indicators of impairment at the end of the reporting period, you will have to retest the cash generating unit to which goodwill has been allocated again at the end of the current reporting period. So how the impairment test works. So basically this slide is showing you what you need to do if you are considering the impairment, which is you have to calculate the recoverable amount of the asset and compare it to the carrying amount. So if your carrying amount of the asset is higher than the recoverable amount, you have to recognize an impairment, which is basically the excess of the carrying amount over the recoverable amount. So you have a choice how you calculate your recoverable amount. Either you can calculate it either as fair value less cost of disposal, or you can calculate it as value in use. You don't need to estimate both of them. If either amount exceed the assets carrying amount, then the asset is not impaired. And so, for example, if you choose to calculate your value in use first, you don't need to, and it doesn't result in impairment, you don't need to go back and calculate the fair value less cost of sales. And happy days. So we can have a closer look on the calculation of value in use. So value in use is pretty much a present value of future cash flows, which are derived from the asset. So in the current environment, it can be extremely challenging to estimate the future cash flows because there are lots of uncertainties existing in the basically current environment. So you need to, when you calculate your value in use, you need to consider various factors. For example, suspended operations or impact of government restrictions or concession in prices, whether you will have to actually provide any discounts to your customers to keep the business going, or whether you need to provide any deferral of payments to your customers. So, and of course, much more. This is not an exhaustive list. So, lots of things have to be considered when trying to estimate the future cash flows. And the uncertainty that I'm talking about can be actually expressed either through expected cash flows or through the discount rate. So you can choose whether you include this uncertainty relating to estimating future cash flows using either expected cash flow approach or a single set of best estimate cash flows. So if you are calculating the expected cash flows, that include calculation of possible scenarios of cash flows weighted by their probabilities and then discounted. However, for example, single set of best estimate cash flows approach is using a discount rate which includes a risk premium. So it is either or, no double dipping. So basically the discount rate that you are using in your to calculate your present value of cash flows should not reflect the uncertainty which was already adjusted in the expected cash flow. So you can choose one of the two methods how to how to include the uncertainty into your calculation. So looking a bit closely at the fair value less cost of disposal. So if you look at how fair value can be calculated, you can use one of the three approaches. It can be either market approach, or you can use income approach or cost approach if there is a lack of market transactions. Whichever valuation technique you use, you should try to maximize the use of observable inputs. So you should actually also consider when you calculate the fair value, whether the valuation technique that you used in the past is still reflecting the current market conditions the best. So it actually can happen that because of the changes to the market, one of the approaches that you used in the past or you have been using for quite a while may not be the best, and then you need to change your approach. So if you do, then this change would be accounted for as a change in accounting estimate under AASB 108. So, and in this case, if you have if you go for a measurement categorized within level 2 or level 3, then you would also need to disclose changes in valuation techniques used and the reasons for making the changes. So if basically you think that the technique that you used in the past is not appropriate anymore and you change it, please go to the standard and make sure that you actually disclose appropriate information as requested. So that was briefly on the impairment of non-financial asset. Now I would shortly talk about the accounting for expected credit losses under IFRS 9. So I would like to mention that there was a guidance issued by IASB on the ECL under IFRS 9. I think it was in March 2020. So the link on my screen is actually the link to the IASB publication. However, as Keith mentioned at the beginning, on our AASB website, we have a COVID-19 dedicated website, which basically shows all the links to the guidance issued. And there is also the link to the guidance issued by IASB. So if you would like to read it, you can go to AASB website and it will navigate you to the IASB publication as well. So some basics for calculating the expected credit losses under IFRS or IFRS 9 or AASB 9. So IFRS 9 sets out a framework for determining the amount of expected credit losses that should be recognized. It requires recognition of 12 months ECLs or lifetime ECLs, depending on the type of assets or credit risk. So the 12 months expected credit losses can be recognized provided there was no significant increase in credit risk on that financial asset. If there was a significant increase in credit risk in the lifetime of expected credit losses, if there was an increase in the significant increase in credit risk, then you have to recognize the lifetime expected credit losses, which basically mean increase in impairment. However, it doesn't set a mechanistic approach to determine when you need to recognize lifetime losses. So the whole model is pretty much based on estimates and management judgment. So it doesn't set exact basis on which you should determine forward-looking scenarios when estimating expected credit losses. So in the current environment, where we have lots of uncertainties, this is becoming quite a challenge. So the judgment is really important, because you have to consider all various scenarios or all various circumstances. You will have to consider whether assumptions used in the past still hold in the current environment, and probably should not continue to apply the existing ECL methodology mechanically. So whatever you did in the past, you lay that and you think whether you need to consider any other circumstances, whether you need to change any assumptions, or whether you need to add new facts and new information into that scenario. So basically what the standard says is that entities should be using reasonable and supportable information available, historic, current, and forward-looking, when they try to determine the expected credit losses. The question we have heard is recently whether actually extension of payment holidays to borrowers automatically result in all instruments having significant increase in credit risk and therefore increase in impairment. So the question is, or the answer is not very straightforward. So this, if you go to the standard, you can find that actually extension of payment holidays may be one of the indicators of significant increase in credit risk. However, an existence of one indicator does not automatically mean increase in credit risk. So again, the extension of payment holidays to borrowers may not automatically mean significant increase in credit risk and therefore increase in impairment. So you need to consider whether actually the extension indicates increase in the risk of default occurring over the lifetime of the loan. So, and it depends, again, it depends on the circumstances. So different factors need to be considered. So I can't probably name all, well, definitely I can't name all of them, but just to give you a few examples, if you are considering, if you are in the situation when you provided extension of payment holidays to your customers. So to give you a few examples that you need to consider is, for example, whether the payment holiday was offered to a particular customer or whether it was offered to the whole portfolio of customers. So what was the reason? Another one that you need to consider is, what was the reason for this offer? Was it really a financial difficulty of the customer, or are there some customers that, you know, can just, it just helps them with the access to funding or easier access to funding? You also need to consider whether it is a short-term or long-term thing. So it is, again, it is just a short-term factor to help your customer to overcome some financial difficulties in the short term, or is it actually, is your customer experiencing long-term financial difficulties? So also consider whether you have sufficient information about each particular customer when making this assessment, or whether it is a portfolio of 1,000 customers. So in that case, you may not have sufficient details to actually estimate the reasons. So I think in short, the extension of payment holidays may or may not result in increased impairment. So it really depends on the facts and circumstances and on the reasons. So it's not automatic, but there will have to be lots of consideration going into the calculation. So The next slide is just summarizing the basic principles of calculation of expected credit losses. And so basically, you have to, when you calculate the ECL, you have to develop estimates based on best available information about past events, current condition, and forecast of economic conditions. In assessing the forecast conditions, of course, you need to consider both the effect of COVID-19 and the significant government support measures that are undertaken. It is likely to be difficult to calculate the expected credit losses at this time. However, changes in economic conditions should be reflected in the macroeconomic scenarios applied and in their weighting. So while it is going to be difficult, this current situation is exactly the situation why the new impairment model under IFRS 9 was developed. So basically, in the time when lots of businesses are going through financial difficulties, it is important to include those difficulties into the forecasts and estimates and basically show them in your financial statements. So the main objective of this impairment model is actually transparency. So that would be probably everything on the expected credit losses, and I will just briefly mention other developments and resources. So Keith already mentioned that AASB and AUSB published the going concern FAQ. Apart from that, we also published in March FAQ which related to impact of coronavirus on financial reporting. That one is more focused on consideration of subsequent event and materiality of the information that should be disclosed. IFRS IASB also published amendment of IFRS 16 on leases, which has relief for lessees. So if you have leases and you want to use that relief, please go to that IFRS 16 amendments. AASB is planning to issue this standard shortly. And we are also preparing some additional FAQs that hopefully would be released within this month. So now I would probably pause and ask whether there are any questions.
Helena, thank you very much for that, and also Dr. Kendall. I noticed one question coming through on the Q&A whilst we wait for any other questions that people may have. And the question is pretty much, is there any expected leniency or concessions during the pandemic recovery phase in terms of, you know, how strictly we apply going concern assessments and fair value? Interested in your thoughts on that.
Well, look, I might take the going concern aspect and just being consistent with the way we've structured things, let Helena add any comments on fair value specifically. But the short answer is no, but it's more of a neutral thing. The thing is, the role of the AASB is not, this is more of an enforcement question. The AASB's role is setting the standards, and it's up to other regulators to enforce those. So that's more of a question that's directed more relevantly to the relevant regulator, depending on the particular circumstances that they're talking about there. The standard hasn't actually changed. So a similar question that might be relevant to that might be relevant to the AASB is, does the AASB propose to change, say, the standard in respect of going concern related to COVID-19? The answer is no, not at this stage. Helena, did you want to add anything regarding fair value considerations to that?
No, I think that's fine what you said.
Yeah.
I don't know whether you can see the Q&A box. If not,
I am seeing them coming up. Yeah,
I can read them out if you'd like.
Yeah.
There's
That's
another
probably
one.
best. Yeah.
Sure. There's a question: can a discount rate using the risk premium method be used to factor in the extent of credit risk instead of probability weighted scenarios under IFRS 9 for the ECL estimation?
So I will take this question. So I'm not quite sure whether I understand, but I understand that we are talking about calculation of the impairment of non-financial assets. So whether the discount rate can include the risk premium reflecting the credit losses. Well, yes, but probably it's not the only risk that should go into that calculation. So the discount rate should probably reflect, if we decide to have the single sets of cash flow, which is the best estimate, then the discount rate should probably reflect more than just credit risk. So it should reflect all the risk included. So, or it could be probably a combination that if you are using the probability weighted scenarios for all the other risks, and however you don't have the credit risk included in that, then it may be a combination.
Thank you. I'll read the next one out. There are some test cases going on right now regarding business interruption and what might constitute a loss. It will be some time before this is tested in the courts. So should we be providing for something in the accounts for this?
Look, this sounds a bit like an impairment question to me. Without a specific example in mind, my inclination is to say, well, yes, if it has a material effect on the accounts, then yes, that should be disclosed. Like I say, in the absence of a specific example, it's a bit hard to be a bit more precise with the answer. But given that Helena dealt with the impairment aspect of the presentation, I'll throw over to her to see if she's got anything to add on that.
Yeah, so I'm not quite sure what they mean by providing for something in the accounts. So if they mean calculation of impairment, and if it relates to the business interruption, then, you know, again, if you calculate your recoverable amount, you basically need to take into account all the or you need to consider all the possible scenarios and assign them, if you are doing the expected cash flows, assign them the probability. However, if you are expecting, I'm not quite sure, because it mentioned that it will be sometime before this is tested in the courts. So whether the question also related that they expect some payment because of the legal action, and whether they should create some provision or account for that. I think that again, for the impairment calculation, you need to consider various scenarios, I would say. and you need to reflect the risk as well. So I think in this case, it would be probably best to discuss it with the auditors, because they may have enough details. I think it's a bit hard to give a general answer for a question which sort of seems to be linking to a very specific situation.
That's the questions that have come through the Q&A at the moment. I was interested also in terms of the pandemic itself, like it's obviously being drawn out over a long period of time, and it might touch on several reporting periods. Is a circumstance that I could foresee it to be difficult in some circumstances to actually draw the link between an event that's happened after the reporting period date that might be caused by the pandemic or not caused by the pandemic. If, for instance, if you took like a reinsurance exposure and your reinsurer collapsed after the reporting date, whether that is, we need to assess whether that is caused by the pandemic or not. Is there a kind of a broad brush approach here that things that are happening after the reporting date could be automatically adjusting events? Or I guess I can see a lot of difficulties there in actually drawing that distinction out. Yeah.
So sorry.
Sorry, you go, Helena. No, you go.
So simple answer is no. There is no general answer. So you have to actually consider the specific circumstances, and it does not really matter whether it was caused by COVID or not, but you have to consider whether the condition existed at the reporting date. So no easy answer. You have to go into the details, and it requires, I agree, it requires significant judgment. Sorry, Keith, would you like to add anything?
Oh, no, that's almost exactly what I was going to say as well. I would take the chance to emphasise a point that Helena did make, though, that whether it was COVID-19 related or not, it doesn't matter. What the real test is, whether there was an indication or knowledge of those circumstances as of the reporting date, which is pretty much what Helena went through, and whether those circumstances are COVID-19 or not, related or not, doesn't have a bearing on whether it constitutes an adjusting event or not.
And I guess, are there any tips for those of us out there who are trying to substantiate future cash flows in this environment? Like we spoke about, modelling forward, but because of all this uncertainty, obviously we need to document our assumptions that we make and try and link it to hard evidence. But there is substantial uncertainty in the market about how it's going to pan out. I guess, is there any kind of tips from that point of view?
Well, look, the only tip I would have in terms of trying to report things as accurately as possible is have a good dialogue with the auditor. That's a point that we've made a few times during this presentation, is understanding what your auditor's expectations are of the financial report, and things will go a lot more smoothly in that respect. In terms of the precise models, the precise cash flow models to apply in valuations, no, I don't have any specific tips on that, nor do I think I should be providing any tips, truth be told. But I'll throw over to Helena there to, if Helena's got anything to add.
Well, I would just to add that the disclosures are probably essential. So whatever method or assumptions you or the preparers actually take when preparing the financial statements, they should be disclosing them, because transparency is really essential, and it's important to the users of the financial statements. So the preparers should think about if they change something, or if there is some important consideration or assumption in the model that they use, they should consider whether it is important for the users of the financial statements, irrespective whether it is required by the standard or not. If there is information they think is important to the users of the financial statements, they should actually disclose it.
That makes sense. Thank you. We have reached 11 o'clock. There is one more question there, if that's okay with you. It's seeking advice in relation to insurance-specific issue of assessment of premium liabilities. When there's like obviously a range of scenarios in the future about future claims, like potentially a second peak in the virus. The question is it best dealt with by disclosure?
I might let Helena take that one.
Yeah, I'm not quite sure whether whether I understand the question, and also probably I'm not a insurance expert, but I would say, well, second peak, again, it's an uncertainty. No one knows. No one knows whether it will be coming or not. So I think it depends how this assumption is included in the model, and how significant it is. And of course, if it is a significant, if it has a significant impact, if this assumption has a significant impact on the result of the model, then it may be something that can be considered for disclosure. But again, I would probably refer to auditors and specific, because it's very specific scenario. But I would say, if it result in a, if the weight or the consideration is actually significant in that assessment, then it may be something that users would be interested in.
Yeah, no, I agree. Thank you very much. I think we have reached time, and there's no more questions on the board there. So I just want to take this opportunity to thank you both very much for contributing today to this webinar. It's been really useful, and look forward to the FSAA engaging with the AASB in the future as more topical issues come to a head. So thank you again, and appreciate your time, and thank you to everyone who's attended today.
Thanks very much for having us, Stephen.
Thank you. Bye.
Bye then.
Bye.